Hey, everybody. Colin Harper, Michael Kutch here, HBK Provident Advisors. Welcome to Friday Live. Hope everybody had a fantastic Thanksgiving. We took last week off. Hopefully you found all those Black Friday deals. Mike, we've had a bit more news than last time we got together on the economic front of things. Powell, the Federal Reserve, they are talking about slowing rates, and I wish that is something I was capable of when it came to eating Thanksgiving leftovers, is slowing my pace. Why don't we dive in and talk about what the Fed's doing and what impact you see that having in the coming weeks and months?
Yeah, you want to just touch on the disclosures real quick before I get started?
Nothing we talk about here is taken as advice. This is just kind of what we see, our opinions. If you want specific advice on your situation, reach out to your trusted professional or give us a call. We'd be happy to chat with you. And with all that fun stuff out of the way, take it away, Mike.
All right. So we saw a nice little rally to end the month for both the equity and fixed income market following that speech you referenced by the Fed Chair Jerome Powell. So he did allude to the likelihood of a slowdown in rate increases starting in December. So that most likely means a half of a percentage increase for the December meeting, which is in a couple weeks. So that's going to take us to the range of 4.25 to 4.5% on the Fed funds rate. Now, the market was already thinking that was the case, but getting confirmation of that was good for sentiment. So we had a nice rally, like I said, in both the equity and fixed income markets. So my biggest takeaway from his remarks was he split core inflation into three components. Those being core goods, the rent component, and then the non-rent component of services. So to give a little indication of where we are with all of those, and he kind of referenced some of these. So core goods has been declining as of the last month or two, and that's due to some easing in supply chains. And we're also going against higher year-over-year numbers. They really started to pick up in late 2021. And then there's the rent component. So he mentioned that has a very long lag, which we all know, to home prices, and that's likely to continue to accelerate in the coming months. So he said really pay close attention to new rents because they tend to reflect where that overall segment's going to be in the future. So new rents have been coming down a lot, but they're at really high levels. I think they got as high as a 20% increase year over year. So they've given a lot of that back, but there's a lot more room to go on that front. But it's good he's splitting that out and not just looking at the headline number. Now, the third component is the non-rent portion of services. So that's primarily tied to the labor market, particularly wage growth. So right now, wage growth is not consistent, and he mentioned this, it's not consistent with the Fed's long-term inflation target of around 2%. So he said that they really have to be 1.5% to 2% higher than the long-term inflation target. So we need to see wages get to a range of below 3.5%, on the low end 3%. So we have a long way to go on that front. That was confirmed in the November jobs report we got today. It showed payrolls grew faster than expected, but there was some moderation from last month, which was increased higher. Now, talking about wage growth, that was the worst news out of the report for the Fed and for the market. With our average hourly earnings came in twice expectations. So they came in at 0.6% for the month. On a year-over-year basis, that's 5.1%. So pretty far from that 3.5% we need to get to. On the market front, the S&P 500 finally got above the 200-day moving average. It's been a long time since we've been above that. However, we did fail once we hit that downtrend line that we've had all year long. Earlier today, we did dip below the 200-day, but currently we're sitting right at about that level, slightly above it. So keep a close eye on both of those levels, and that's really going to show us whether this rally has more legs to go. If we fail here, it's likely that we'll just move back down to at least 3,900, if not lower. Like I mentioned, we did have a nice decline in bond yields over the last month, giving a nice rally to them. And that kind of reversed today on the jobs report. It's given a little bit back. Pay particular attention to the long end of the Treasury yield. The 10-year hit some key support at 3.5%. It's bouncing higher off of that today. So if that reverses and continues to go higher, that's going to be a big headwind for the more growth areas of the market, particularly tech. So keep a close eye on that. If we break below that, it could give more legs to the growth trade. Another thing to watch is the dollar. We have broken the uptrend in the dollar and are currently below the 200-day moving average on that. So that's probably going to continue to fade, which will be good for companies with international exposure, as well as international in general. Both international, developed, and EM had a really nice rally this month, but they're still underperforming the S&P for the year.
So, Mike, would you say that what the Fed is doing is we're starting to see glimpses of success there, judging by the what they came out and announced in their plan going forward with rate changes? Oh, it looks like we have a
went out.
Oh, there we go. You're there still.
Okay. Yeah, so we are seeing some signs that inflation is slowing. It's still at very elevated levels. So although the Fed's going to slow the pace of rate hikes in the coming months, they still need to get to a high level, and that high level is still likely to be around 5%. So overall, the economy has been holding up pretty well. The jobs market is very tight still, but that tends to be one of the last legs to fall. We did see manufacturing in the latest report decline into contractionary territory. So there's certain signs that the economy is slowing, but overall, it's really not in that bad of shape. So we need to see some more deterioration in the economy before inflation can really come down and for the Fed to back off. But it's likely the Fed's going to keep rates high unless those economic numbers really start to fall off a cliff. And then in that case, they would likely cut at that point.
So really we need more bad news to indicate good news as far as we need we need a lot of things to slow down for inflation to slow down, it sounds like.
Right. Yeah. So for the next month or so, at least, we'll probably have that scenario where bad news is good news for the stock market. But then that's going to start to turn where bad news is in fact bad news. And the stock market and investors look more toward the slowdown in the economy versus inflation.
Well, I do not envy you in your position here. For those of you that don't know, Mike's entire responsibility for us is to manage client accounts and portfolios for us and really keep a track on short-term and long-term, holdings. And it's been a very difficult market to navigate this year. And in my biased opinion, you've done a great job. So it's always great to get your insight on what's going on out there and what do you see, and kind of building on from that, maybe somebody who's, thinking about what we're doing from a positioning standpoint. What do you think your steps are given the current environment we're seeing out there?
Yeah. So overall, we do have a chance that this so-called Santa Claus rally continues for the next couple weeks to a month or so. But from a valuations perspective, we're about 17 and a half times forward earnings on the S&P 500, and that's given where earnings currently are at. So I do think the earnings estimates need to come down a little more, and 17 and a half is still not cheap by any sense. So I really think we're kind of limited on the upside. I'm probably going to be more of a seller here into this rally. We do still have a decent cash position in all of our portfolios. I would likely add to that cash position for more of the growth areas, because that trade is just going to be tough with how high rates are, and they're going to keep moving higher in the coming months. At a certain point, that's going to reverse, but for the time being, they still have some headwinds ahead of them. Value has certainly been the outperformer this year, and technically most sectors look a lot better than the growth areas. But I'm a little hesitant to go too overweight value, except for energy. We do have an overweight exposure to energy. And that's solely because I do think we are in the midst of an economic slowdown, and there is a higher chance of a recession. and typically value doesn't do very good in those environments. Healthcare remains my highest conviction. It kind of plays into both a defensive nature and some offense in there. Other defensives will probably continue to do pretty well. They typically do well in recessions, but they're not cheap by any means. So you kind of have to be selective in that area.
That makes perfect sense. I think that's a lot of good food for thought there on what we're doing from a positioning standpoint. Kind of building away from the markets for a little bit and talk about just some quick year-end reminders, some food for thought for everyone listening to take with you as we kind of roll through here. I would say probably a couple reminders. If you turn 72 this year, you're already 72. You are required to take a required minimum distribution out of your traditional IRA, so just make sure you get that done. I think most of the folks we work with have gotten that taken care of already, but only a couple weeks left to do that. That's one of the big ones. Also, if you want to do any tax loss harvesting, now's probably a very good time for a lot of folks to do that. Feel free to reach out to us and we can talk through what that looks like. Very simply, we're going to sell stuff we bought lower than what we bought it for, and realize some of those losses, which certainly has the potential to help out on your taxes next year. But that's it for me. Nothing too involved on the planning side of it. Mike, as always, thank you so much for the commentary. Everybody stay safe, happy, and healthy. I know we have the holiday season upon us. Hopefully you all had a wonderful Thanksgiving, and looking forward to catching up with everybody next week. Have a wonderful weekend.
All right. Bye.
Thanks, Mike. Bye-bye.